Welcome to the Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is Friday, March 1st, 2024. S&P 500 currently sitting at 5133. I'm David Zarling. I'm with the official Gamecock alumni, Ian McMillan. We're heading into the most exciting part of the year, in my opinion, for basketball, whether it's NBA or NCAA. But the Gamecocks are representing well.
It's been a great basketball season, both men's and women's. Always pretty good for women's, which is awesome. But yeah, men's have big turnaround this year. So it's exciting to reach March 1st and be concerned about where would our men's basketball team be? What seed would they get in the NCAA tournament? It's not a thought I've had to stress over very much in my life.
It's almost like it was a dip that should have been bought, potentially.
That should have been bought. And you and I had a good conversation on this just earlier. What happened to BTFD?
Yeah, what is that?
I thought that's what we like. If this was 2020, 2021,
yes.
I mean, people would be breaking their desks because that's how hard they pounded the table.
That's right.
I thought that's what we did in uptrends. BTFD.
You gotta buy the dip.
But that mindset, that
mantra, for sure.
That force that was on those markets, coming out of the COVID crash. And I don't know, how long was that? Like 18 months maybe that lasted?
Well, and I would even say if the precursor to that was even 2017.
That's true. Yeah, 2017.
You're
right.
You had to buy the dip. And when's the last time you heard buy the dip?
I mean, VIX is back to where it was, right? I mean, this is your VIX. We've talked about this multiple times over the last few months. You get a low VIX. This is melt up territory. But a lot more angst continues to be seen. Dave, we just closed out February. Not a bad month.
No.
Not a bad month.
And a month, seasonally speaking, that has typically been weak.
It was supposed to be. Great point. It was supposed to be, maybe a good first week or two, but then things are supposed to get a little wonky, and they did not. We have not yet gotten any of the expected seasonal weakness. I think that's the best way to phrase it. Nothing yet. Trend very, very strong. The number you just gave out was the highest number you've ever given out on a recording of this podcast. So all-time highs again today.
And that's the most bullish thing a market can do, right? Is record a new all-time high.
We got new all-time highs, and we continue to see these spurts of, participation really turning around. And okay, so again, let's take February for an example. Russell, NASDAQ, S&P. So you've got everything from small cap value to large and mega cap growth and everything in between, all up 5% in February. And all pretty close to, I think, within like half a percentage of each other.
That almost sounds like breadth expansion.
Yeah, I mean, there is, it was a great month. Seems like we made it through another, the depths of the earnings season without the indices getting too beat up.
Well, it is interesting that, from a seasonal perspective, Valentine's Day through the end of February has been weak. We didn't see that.
Didn't see it.
Now, in addition, the Ides of March, heading into March, that also tends to be weak. If we don't see that, and we've said on here in the past that if we don't see it, that's the information we want to pay attention to. Again, seasonality is not a predictor. It's just being aware of what seasonality is and when you see something other than that. And right now, February was something other than that. It was a stronger month than what we see seasonally speaking. So it does make you sit back and go, wait, is the rest of this year potentially stronger than we thought possible? That thesis is now on the table.
Don't get to December 31st and say, wow, it was a low volatile year. Don't let that happen. There's a lot of disbelief out there that this has got to end. And I got to be honest. Well, I mean, we've covered this, right? We know that everything outside the Russell is at all-time highs. There's no price history to the left to use as resistance, which is pretty bullish when it comes to a price behavior standpoint.
That they've been willing to buy stocks, broadly speaking, S&P, NASDAQ 100. You talk about the DAX, you talk about the Nikkei. These are things that buyers are willing to buy at a higher price than they ever have been before. Is that what you're saying?
A couple days ago, I was just looking at some very big picture Fibonacci extensions. Whether we look at the COVID drawdown, the 2022 drawdown, the recent drawdown we had last year, was it like August through Halloween, basically?
Yeah, Reformation, yeah.
You want to look at all those. And again, I mean, it's the same picture being painted, especially even, I would say, intermediate term. We want to look at it in a mathematical sense and use Fibonacci's. We don't really start running into anything, or can expect to start running into anything up until like above 5,300, maybe 5,400 on the S&P.
Oh, so you're using S&P.
S&P,
Fibonacci
extensions, three very big picture, broad ones. If you're at home, you can do this. So COVID drawdown, 2022 drawdown, and the recent August through October drawdown that we had last year that we're still, in the current rally coming off of that.
Well, and Ian, the Fibonacci extension. So for our listeners who might not be familiar with Fibonacci, is this math sequence that we see over and over in nature, right? Think about the numbers 1, and you add 1 to 1, that's 2, 1 to 2, that's 3, 2 to 3, that's 5, 3 to 5, that's 8, right? And you go down that sequence. We see this everywhere in nature. It could be how our limbs are, how our digits are, how seashells, sunflowers, the way trees branch. We see this in markets.
Famous, who did the painting with the guy with all the arms?
Oh, I don't know. I don't know this one.
The guy with the Michelangelo?
Well, that would be a good, I would make a guess like that. With all the arms. You mean as far as like they're symmetrically,
it's like a big circle.
Oh, yes. I know what you're talking about. Like, it's used a lot by physicians or in the medical community. That's what you're talking about. Yes.
Vertuvian Man.
Yeah, Vertuvian Man. And
Da Vinci. I apologize, Leonardo da Vinci.
Yes. Not one of the Ninja Turtles, but an actual artist. And when you observe,
it's about body proportions, and I think there's some Fibonacci in that.
Oh, 100%. Like the distance between your AC joint and your elbow joint and your wrist and your hand, there's Fibonacci levels there, meaning like there's things are built in symmetry, not symmetry being 1 to 1, the sequence of Fibonacci. What you're saying is in the market that we see the same thing, which we do over and over, is this Fibonacci sequence. And what's interesting, Ian, and what I'm looking at is the drawdown that took place in the S&P 500 in 21 and to 22. If I use the level of 4,800 where we reclaimed, the 1.618 extension is 5,600.
Dave, don't say that. You're going to make people cry.
Maybe tears even happen in Fibonacci sequence.
Don't be hurting people's feelings out here because they're not BTFD.
BTFD, you got to buy the dip.
I don't have really any money to buy the dip, but
it's all invested.
Yeah, I was about to say because it's all been pretty heavily allocated. But, and this goes back to another conversation we had. Okay, so clearly someone's out here buying the dip. not the people that are in my comments on Twitter, but someone out here is buying the dip because we're in a very low volatility. We've talked about this for we're clearly in an environment where like every 1% to 2% correction, even intraday, overnight gap downs, everything continues to get bought up. So someone is hitting a buy button. Any thoughts on where that demand, that's what it is, what is coming from?
Well, first and foremost, it has to be institutions, right?
Has to be institutions.
It has to be firms that are mad.
It's not my mom buying
and it's
SPY.
And it's not my son. We love those people, the people we just mentioned, but what they're putting their money to work is not moving the market. There are billions and trillions of dollars at stake that are moving this market higher. The market does appear to be on this move of not letting anybody in. And what I mean by that is, imagine trying to jump on a train that's going 65 miles an hour.
Well, and how many people have told them, like, even if you've accepted, like, hey, I'm under allocated and we're clearly in a bull market, I need to adjust, right? And that can be a plausible mindset to have. And you know what, Dave? Let's put another 15% to work on the next 7% correction. That never comes.
Right. It's the hard part. The market is really good at making a lot of people feel foolish. I mean, that's what markets do. It's by definition inefficient. Product's not the right term, but the movement in markets tends to make the most fools out of the most people.
And I have been a fool. I'll be the first. Like, I've been on the foolish side. As everyone listening to this has as well.
Oh, absolutely. 100%. Myself, everybody. Like, there's no one that says, oh yeah, I played the market perfectly. That's not a thing. That's not a possibility. It's not a thing. Anybody who tells you that is lying. So we're in this market environment where it continues to move higher. And February is supposed to be seasonally weak, March as well. And so it will be interesting. Like, Ian and I are not sitting here going, well, the market's going to go up in March. That's not what we're saying. We're saying it went up in February when February was seasonally weak. And you throw in the 17, 18 weeks that we've seen, the price thrust. I think we talked about this a little bit last podcast. There is overwhelming demand in this market. And if you don't get that 5 to 10% correction that you could take advantage of, that's like, you're now stuck. You're in a situation where you can't.
If that is your process in the game you're playing, you're definitely have been caught in a mental conundrum.
Yeah, we're definitely at a spot. Try to paint this picture for our listeners from a really big picture perspective. So those who've been listening to us for a while understand 4180, right? I can't believe I'm saying it again.
4180. God, we haven't talked to our listeners are probably saying, please don't. Please don't bring that up again.
Right. That was the level. We cleared it. We got above it. We corrected back into it. And then we moved higher. The other level is this 4,800 on the S&P 500 that we cleared back in January.
Yeah.
That was 2 years in the making, right? We had a podcast labeled that 2 years in the making. The market didn't go anywhere for 2 years. And so now we're in this, I would argue, sentiment / narrative of disbelief or skepticism.
Yeah. Like, people being worn out.
Right. Like, have you seen the new, I'm sending this to you now, Ian, the cover of The Economist, the most recent one?
I know we like to talk about magazine covers, and I'm a big believer in the fade the magazine cover, especially something like The Economist. Jeez Louise. Yeah, I've seen it, and I'm looking at it now.
So the description, the cover is, it's a bull, right? It's a bull that is strapped to a bunch of balloons that's moving higher. And the question that The Economist asks, how high can markets go? Now, and let me know if you think differently, Ian. That seems skeptical as a cover, meaning like it's giving the impression of a bubble. It's not using bubbles, it's using balloons. And the market is moving higher. Well, how can that possibly be? It seems skeptical.
I take the same stance, which I think fits the overall kind of viewpoint, right? Because the market move, the bear market felt like it lined up how everyone was feeling, right?
Yep.
That made sense because there was so much angst and frustration and Inflation was really a big talk, lots of things going on. So the feeling of like life has gotten worse, life has gotten harder. So, it would make sense that the stock market would go down. Well,
Right.
a lot of that angst, and I'm not saying it's wrong. I'm not saying it's wrong to feel that way. I think a majority of Americans are frustrated. And, when it comes to inflation and the way certain things have unraveled over the last 3 or 4 years, we're not going to get into that. But at this moment, the market direction is not lining up with that. And that leads to, a word you used, which was disbelief. Why is this happening? I'm spending less money, right? People are saying, well, I'm out here spending less money. I'm penny pinching. We're watching our bills. How can these companies, how can their stocks go up?
Yeah.
And again, exhibit 4,385 of our, we're almost at 200 episodes doing this, that's not the way the market works.
Right.
It's not the way the market works.
It always leads. It always leads. It's the only coincident or leading indicator that we have, because I know opponents or critical individuals of technical analysis will say, oh, well, that you're just looking at information from the past. You're looking at price. That's information from the past. Well, no one has information from the future.
Yeah.
And if you do, that's weird.
That's weird. And please spare me your S&P targets, you dorks.
Right, exactly. Or the targets that say, hey, we're raising the price target, but we're keeping a sell rating, whatever.
Yeah.
If you're one of the big houses, you should that should be a wake up moment. Like, I'm putting a higher price on this, but I'm saying it's a sell.
Yeah, you should fire that guy.
Yeah. Fire it, or that guy should move on to a different firm and be like, why am I making this recommendation? But anyway, your point is extremely valid that the market doesn't really care what you or I think. It's going to do what it's going to do. And while inflation and cost of goods, these real world experiences are real, it's not that the market sits there and cares about your feelings. And sometimes that can be offensive. Like, wait, the market doesn't care about my opinion. The market doesn't care about my feelings. Doesn't matter. The market's going to do what market's going to do. And it's economics 101. It's supply and demand. Obviously, there's demand for stocks right now over supply, to the point where we're reaching new all-time highs, to the point where we're seeing the Nikkei, the Japanese stock market, reach 40,000 before Dow Jones does. Did you have that on your?
I did not have that on my bingo card for 2024. Crazy. I mean, and what's also kind of interesting, and this is why, hey, you got to live in the moment. Things change. You remember when the Dow was the first to break to new all-time highs?
Yes.
It's been a laggard since that happened.
Yeah, that is such a good point.
Yeah, I would have had Dow getting to, if you would have told me S&P is going to do X, what do you think Dow will be on March 1st? I've been like, yeah, I mean, it's been the leader. It should stay. But things changed, and that's why, you got to look at things daily and monitor. I would also say, Dave, in regards to this BTFD question, where does the demand come from? I remember we talked about on our podcast about all the trillions with a T money going into money market funds.
Oh, yeah.
As everyone was just, let me take a deep breath and I can get my 5% risk free. And now
so true.
We've ripped 25% in 4 months. We don't do this at our firm, but firms, advisors, planners that do things to appease their clients' feelings in the moment. And they said, okay, we'll get you your short-term T-bills. We'll get you your money market so that you can sleep better at night. Now that stocks have ripped 6-7% a month for the last 4 months, they're showing up at their advisor's door and saying, why do you have me in a money market?
Yeah.
when the S&P's up this month, when stocks are doing so well, why would I be in a money market? Conversations are happening. I know that they don't happen on our team or, in our financial planning division, but I guarantee you those conversations are being had at RIAs and financial planning firms across this nation.
Oh, 100%.
It's just human behavior.
And that's one of the things that we do here at Client First is we help people manage their emotions, right? We're an emotional bodyguard. And to Ian's point, we did have clients saying, why can't we just own T-bills? Why can't we just own the money market back in November of 2023? To which, as a fiduciary, you say, no, like, I understand that you want to own that. If it fits in your financial plan, yes, we'll own it.
Yeah, and there is a piece. There's absolutely a piece that it can work.
Right. But at the same time, we need to be involved with this market at this point.
Yeah.
And like you said, we've now moved 24, 25% higher and something like the S&P 500. Now you're talking about those T-bills being a tremendous opportunity cost. And this goes back to that fiduciary responsibility of being the surgeon in the room. Do I care about my patient? 100%. When my patient gets uncomfortable with the surgery, I have to step up as an emotional bodyguard and be like, let's finish the surgery. Let's finish the procedure so that you get healthy again. That's the same thing that happens in markets. Is there's a time where advisors and planners need to step up to the plate and say, no, Mr. and Mrs. Client, this is actually in your best interest to be involved with the market and not just buying T-bills. And I think that's
you're trying to hit your retirement goals.
Right.
You want to hit your retirement or stay on track for your retirement goals or catch like whatever it is. It's not about always like what the client thinks is best. In fact, it's rarely is the client's emotional response, a short-term emotional response from a client, going to be the best long-term option for them. Yeah. Also, a client's not going to come back and tell you, okay, you know what? I had a good couple of nights of rest. I thought about it and I'm actually, let's turn the risk level back up. I want to get back in stocks. They're never going to say that until they come to you with some WTF moment of what have you been doing? Why have I underperformed? I'm not on track. Bob told me he's in NVIDIA. His guys got him in NVIDIA and he's 45% this year. I was just talking to him at the country club over the weekend and he's way up. And you've got me in 33% allocation to T-bills.
Mm-hmm.
I guarantee you that's happening. Guarantee it.
100%. I encourage any advisor or planner that's listening to this that if you're using technical analysis, it does give you the tools to say when something is in the best interest of someone else. I don't know how you do that based on a guess or an opinion on earnings or things like that. But using technical analysis, it's the fact that sits there and it's what we get paid in, which I mean is like when we buy and sell something, it's in price. And so by tracking price, we get it to identify when relative strength is taking place and we get to pay attention. We also get to use client information as sentiment and identify, wow, there's an overwhelming sentiment amongst peers, clients, because the other thing that was going on, Ian, was 5%. I'm going to use the term guaranteed. Please forgive me. It's obviously not guaranteed, but it's as guaranteed as you can get when you talk about short duration, right? T-bills that are anywhere from 6 weeks to, 9 months, 12 months that are paying these type of rates. That's about as guaranteed you get that an audience has not seen for a long, long time. I get the temptation of, hey,
and a lot of those, and that's a generation too, right? When they see, and golly, they see something yielding over 5%. I mean, it's how a lot of them built their wealth to begin with.
That's a huge deal, especially when you consider that for many, many years it was sub 1%, and now you're telling me I can just park my $1 million and get 5%. And I'm not saying that parking $1 million and getting 5% is wrong, but we do get to say there's opportunity cost. And by using charts, we get to say there was 25% opportunity cost over the last 4 months. And that is worth highlighting. And now we're not here to say, Ian's not saying that this continues forever,
No.
but we are at a unique spot in the market from a standpoint of we just bucked the trend of seasonality for February, meaning February in election year of an incumbent has been weak. We weren't from a market standpoint. We just went through a 2.5 month breadth correction. We have small caps firming up above 1900, 190 on IWM. And I think, and this again, market doesn't care what I think. People shouldn't care what I think. But the evidence is sitting there for the thesis of surprise to the upside.
Would that be the pain trade? Right?
Yes.
And people be say crazy. Ian, shut up. How could the pain trade be higher? Because I'm telling you, people are underexposed. I'm telling you this.
Yep. They are. And the cover of the Economist magazine with the balloons on the bull.
And there's no setup to get in.
Right.
There's no setup to get in.
And that correct. Yes, that is a great way to say it. Like, I can't think of a good analogy or the way to communicate this. What Ian is saying is the rocket has launched.
Like a technician's going to tell you, well, you can't buy now.
Well, yeah, correct. How are you going to grab onto this right here?
Yeah, with a good risk reward. And I'm not saying that there is. I'm not saying that there isn't. I mean, right. I'm not disagreeing. But yeah, like the ship has sailed and you can hop on, but yeah, you're not standing at the port. I mean, you're hopping on in the middle of the ocean.
And this goes back to the original point that you're making, is the environment that we're in is the return of BTFD. And I think you and I are saying that this is the return of that environment before that. So if the Twitterverse, clients, peers, your son, your mom say, hey, we just need to buy this dip, that would be different. We're saying it for the first time now in 2 or 3 years.
Yeah.
That this appears to be a BTFD type market.
Because the D continues to be bead.
Yes.
We're not guessing. I'm telling you, it's that low volatility. And again, as we always say, this could end tomorrow. Could end Monday.
It could. Yes.
Could end Monday. Could have a 1% gap down, and we go into a 10% correction. It's a non-0% chance. All Dave and I can tell you is what we continue to witness on a day-to-day basis. The data that we are given, I guess it technically updates every second, but obviously we're not stressed over that type of time frame. Look at the charts, it's an uptrend. If you are a trend follower, I do think that this environment has kind of like who's a trend follower and who says they're a trend follower. Because if you're a trend follower, I'm not saying that this hasn't been a steep ride, but if you're a trend follower, you've participated.
Right.
And there has been a lot of skepticism. There has been a lot of doubt during this rally from those that would put themselves in the trend following bucket.
I mean, and this goes back to, and we've highlighted this in the past, right? When we talk about bull markets are born on despair, grow on skepticism, mature on optimism, and die on euphoria.
So you asked this. Okay, go ahead. I know where you're going.
My point is, I don't think we're at despair. I don't think we're at euphoria.
You asked this like 3 weeks ago, and what did we say?
We came up with skepticism.
Skepticism.
And that's where I think we are. I still think we're in skepticism because, like, even the Economist magazine cover of the insinuation that the balloons are going to pop and the bull is over, that reeks of skepticism.
It does. That's a great word. It does reek of skepticism. We are absolutely, no one will convince me that on March 1st, 2024, we have escalated into optimism.
Or even euphoria. Like,
no, we're definitely not at optimism. Of like, okay, things are pretty good. You know, maybe this does make sense.
And 1000%, it's not euphoria.
Definitely not euphoria.
because
Where
euphoria
people
would be
people. That was when like people were quitting their jobs to,
yes,
you know, it doesn't always have to be. You've talked about it. It doesn't always have to be stopped. People quitting their jobs to become real estate agents in
right?
2007.
Yes, and they were like when the checkout clerk hands you their real estate card. Okay, maybe we're at euphoria. Like we could be like during the COVID era. I'm buying stocks. I'm buying stocks. BTFD. That's euphoria. When we say BTFD, when we say buy the dip, buy the freaking dip, we're saying it before it becomes the mantra of the populace.
Yeah, because if this continues, you're gonna see people capitulate, and they're gonna say, "Well, I guess markets just only go up,"
Right.
even though we're like 16 months removed from a 30% drawdown in the broad market. People are
Right.
but
Well, and Ian, small caps are just breaking out of their range.
can you imagine the pissiness? Pardon my French. From
Is that
people out
pissiness? Is pissiness French? I like it.
it could be from people out there if small caps, and a lot of it's gonna be these 2020, 2021 names that are coming out of bases. Like look at Robinhood, that's coming out of a base.
That's a great base.
Yeah. And all these people that got in, IPO stage because, Robinhood's the future, or stocks like this. They all got in 2020, 2021. They rode down, 85, 90% in 2021, 2022. They obviously all had to go get real jobs, so they're not at home day trading stocks and zero DTE options anymore. This is the type of stuff that's going to go up without those people. And maybe Robinhood, maybe look back in 15 years and Robinhood's some like legitimate brokerage company. I mean, I know it's legitimate now, quote unquote, but
Oh, I mean, that's a fair point.
Seriously by anyone outside of, it's not taken seriously by anyone in the institutional world.
But it could be. It could be
one day.
Robinhood reeks of, I can't believe I'm using reek in a second time, from 1970s Charles Schwab.
Oh, really?
Well, just Charles Schwab shook up the market in the 70s.
Okay.
And it was one of those where you could access things easier than you could before. Things were cheaper than they were before. Robinhood seems to be that kind of same ilk. However,
yeah, I can see that.
I want to be careful because Mama said there was no such thing as a free lunch. And that remains to be true.
They were selling data back then.
Yeah, right. And so I don't want to sit here and pretend that Robinhood, a quality company, isn't selling data or passing along costs in such a way that it's just something to be aware of. And so it's not that Robinhood's not being taken serious, but here we have a quality platform that makes it really easy for the masses to access stocks or crypto, right? And so when we expand this, when I look at Robinhood, the base that's happening there that started in 2022, so now we're talking about a 2-year base. You see the same thing in retail overall, like XRT,
IPO.
See,
it's like those types of names.
Right. That's a big deal.
It's a huge deal. Whether they start significantly outperforming or not, I don't know. The relative charts aren't, like I'm looking at IPO right now. See the potential, but it's not breaking any relative highs. But those are the types of names where they're coming back. They are participating. They're part of, when we look at new highs, new lows, those get counted in new highs. Those are the things under the surface. We've talked about, how many weeks ago when people were starting to get real antsy, like mid-January. Remember when people were starting to get real antsy over small caps, Dave, because small caps hadn't gone anywhere.
Right.
And it's like, but they're still leading off the bot. And the same is true today. When we go back to the October 31st lows or October 30th, whatever you want to call them, we'll call them Halloween. S&P is in third place.
I think that's such a great thing to bring up because Right. We talk about on this podcast how many times about behavioral levels, right? When we talk about Ballmageddon, right? January of 2018. When we talk about the breath thrust that we saw last year, the October November event where we saw breath thrusts in November and December, the areas that led are small caps, and they continue to be. Now, I know we pulled back into that area, but is that not information that we should really pay attention to? That when we saw a breath thrust environment, breath thrust meaning an increase in participation, that we saw small caps lead out of that? Shouldn't we pay attention to that? I think so.
And it does. There's small caps, it's higher beta. It's makes sense that it's going to kind of happen in clusters like we've seen in February and this week, last 2 weeks, right? Especially mid caps. I know Dietrich and those guys are they're actually a little bit more overweight the mid caps, but they're preaching the same mantra. We're kind of coming. You probably might want to think about being invested in the average stock here more than mega cap 7, magnificent 7.
And that's the big thing is when you look at what's happened in January and February and what happened in 2023 as a whole, it is interesting to identify that there is information. There's a thesis that sits there and says, whoa, there might be another breadth expansion upon us. Like we look at bullish percent and we're still at midfield, right? So defense looks to have held. And I'm guessing that we're about to get some readings in bullish percent for the NYSE that move into X's, meaning the offense is back on the field. And this is happening in a broad index rising environment. We might see expansion at this point, which does seem quote unquote unbelievable.
Right? After a 25% rally, what if we get some type now? I don't know how closely you can have another Whaley breadth thrust, but some type of breadth expansion at this point in the rally, people are going to pull their hair out, Dave.
If we can continue to see demand outpace supply heading into summer, that bucks the seasonal trend of a weak March. And that's why we should pay attention to March. Like if we have a consolidating March or a weak March, that's fine. But if we don't, I mean, how much information is that? It's pretty significant. And it goes back to what you said earlier in the episode, which is how do you manage risk at this point? Like if you're not involved, it's like you're caught without your swimsuit when the tide goes out. Like what are you supposed to do if you're not involved in this?
And if that's not part of your process, no one feels mentally comfortable. Like, oh, what am I going to do now? Look, buy another 10%, buy another 10%. No one wants to do that when they're caught off guard. Instead of just own things when the market's up, don't own things when the market's going down.
That's not sexy. Well, and we haven't talked about, there's so many developments. For example, like VEU, Vanguard All World minus US, going out at price levels that we haven't seen since April 2022. I'm not saying we're at all-time highs. I'm not saying we need to get overweight international. But if you're telling me we're buying international stocks, that's risk on type behavior.
They're buying them.
Yeah. It's all about environmental information. And this goes back to small caps. Small caps have been under favor for a while. They could continue. That I'm not here to on this episode to say that's not going to continue, but there's some really logical levels from a relative perspective that go back to the late part of 2023 that you've highlighted since the breadth expansion, the Whaley and the Zwig breadth thrust that we saw late last year. So you're telling me micro caps and small caps and these things are going to move higher and that's going to be negative for the market? It's hard to say that, but it's also the market is this living organism where not all the things are the same. Like, for example, S&P 500 today, up nicely.
Yep.
Apple trying to hold on to this 180 level.
Yeah. Interesting candle today. Still kind of creating this range, 180 and 198, 200, I guess, if you want to call it. But yeah.
Well, Well,
In the
and
market. So we've done all this without. You're telling me, Dave,
yes, yes,
Dave,
I love this. I love where you're going. Please go here.
that's now I'm gonna have to call you out online. So you're telling me we've rallied all this way in the last 2.5 months? Apple, the most important stock. Microsoft's the highest weighted now.
Yeah.
But we've
But
done
no,
this. We've done this without Apple.
but I love this. So what Ian is highlighting is that Apple, since mid-December, since the breath thrusts, is down 9%.
That's crazy.
Small caps since mid-December are positive. However you want to slice it, Apple is an important part of a cap-weighted index. We're accomplishing this without Apple. This tells me, is there a new potential leadership regime underway? And what if Apple does hold 180 and moves higher? Like how how accelerated does this
Yeah,
get?
I mean, even if it underperforms, it's a solid tailwind.
Yeah. And I get nervous about how bullish I've become. I'm as nervous, it's weird. I'm as nervous as early November from a paranoia perspective of you just had this flush,
Yeah.
you had this selling exhaustion followed by massive expansion in buying. We've seen nothing but higher prices since. It's a very not similar but similar environment from the thing you're pointing out from Apple is that this acceleration, this move to the upside has not included Apple. That's incredible.
It rebounded there for the first 4 or 5 weeks, but then fizzled off. And here we are 4 months later, hitting more all-time highs. Like, I mean, barring some type of horrible last hour and a half of the market here. And we just got new monthly closing highs, right? Go pull up the monthly chart of S&P, and you've got that big old green candle sticking out there.
It's a market where it continues to confirm demand outpacing supply at a pace that most cannot manage risk with.
I think that is such a good way of explaining the predicament that a lot of people are in.
Because what are you supposed to do right now if you're not long? I mean, I suppose if you're a good technician, you can use small caps here. But if you're not long in other aspects,
And
you're
you've got to find, I mean, you've kind of had to find one. And 4,800 was kind of your last spot. Because I remember I did that. We were very overexposed when we got back above the 200-day and into 4,800. 4,800, we went back a little bit closer to 100%. And then above 4,800, it was like, okay, I guess. And we did consolidate there for a little bit. So we kind of, obviously, we wanted to stay participated. And mid-January, we got back above 4,800. And it's like, okay, push the exposure back up. And this is going to be our new line in the sand. And that's kind of been your last line in the sand. And that was your last price history to the left.
You're sitting at a point where you could absolutely, from a market perspective, pull back into 4,800, which would be about a 6.5 to 7% correction. I'm sure the bears on parade would come out and highlight how negative that is.
Saying back to 4,800?
Yeah, if we had a check back, if we had a pullback into 4,800.
Oh my gosh, can you imagine oh my God, here we go.
Right. At the same time, it would be the most wonderful opportunity to get back involved if you haven't been.
I 1,000% agree. Grayson Rose, actually, with stockcharts.com, he made this good point. Like, hey, I love the uptrend, but a very classic, well-behaved correction back into 4,800 would be absolutely, I might literally buy a Brinks truck if we got that. I'll back it up.
Yeah.
And if that was your plan, and again, so back to our point earlier, how many people that was going to be their MO? Oh, I'll buy the pullback. Because why? And I'm not saying it still doesn't happen. And it could even happen from higher. We could end up having a 15% correction back into 4,800. Where when you look at it on a big term chart, you're going to be like, oh, that was nothing. But of course, intermediate term, it's going to feel horrible. But we haven't gotten it. And that has bled into this. How do you get it? If you're a
Exactly.
fundamentalist, I don't know how those dudes would do it. But yeah, if you're waiting for a, Shiller Cape ratio, or
Forward PE.
I actually saw something, I think it was from Dietrich, about how Nvidia is actually cheaper, right? Because here's the whole thing. Nvidia's earnings have now kept up with the price movement. And thus the PE ratio isn't some horrible, unbearable thing to look at, even from a fundamental perspective. I think he said, do not quote me on this. I am 90% sure this was Dietrich. And because they do a bit of his partner, and they do a little bit of fundamental. But something how Nvidia is cheaper than it was like 2 years ago.
Price always moves first. Wet streets don't cause rain. Price moves first, and then the narrative comes out. This is about as bullish a podcast as we've had. And so I'm fully ready for, do we have some type of pullback?
Are we bullish, or are we just factual? I have a hard time. I wouldn't say, no, I'm probably biased. It is, I would say we've been bullish for
Since the flush of
the last 3 or 4 months.
Yeah, since the flush of late October, early November. I mean, both externally and internally, the things that we've shared are extremely bullish since then.
They
And
have.
so you sit here and go, I just think your point about you're in this spot from a market perspective and a risk management perspective is if you're not involved, how do you get involved?
Okay, I mean, look at episode 184, David. Table is set. That was the title.
Yeah.
Table is set.
Yep, it is. It was. And Mr. Market showed up and he partied. That's all he's done. We haven't even touched base on credit markets.
We didn't talk about crypto.
We
spent. I would say this was our biggest episode in 4+ years of touching on like psychology.
Yeah.
Like trying to dig deeper into like why are market participants, or at least retail market participants, we clearly know institutions are pushing this higher. Why is the broad market mindset been, again, to use your word, disbelief?
I think that's accurate. I think that magazine covers are confirming it. Our clients are confirming it. And again, this is all subjective. This is not a hard and fast data points. It's just observing the world around you and saying there's skepticism here. This is not optimism. There's areas of optimism. I'm not saying there's not optimism, but the amount of skepticism is real. Oh my goodness. If my mom texts me about Bitcoin, I'll be on here telling you about it. She's not. It's not a thing. Like, it doesn't exist to her.
Okay, so does your mom listen to the podcast?
That's a great question. I'm going to have to ask. I think she does
religiously.
I love Nana.
My mom would never text me because she's going to be like, oh my God, if I text him, he's going to think he needs to sell Bitcoin.
That's great. I love that. So I need to meet Nana in person. Nana, if you're listening, I love you. I know Ian loves you tremendously. I look forward to meeting you. I love that insight, Ian, because she's like, that
would absolutely be her mindset. She's like, well, I can't text him. Marty, I can't text him. Then he's going to think he needs to sell his Bitcoin.
That's so funny. So true. No, my mother does not listen as well as yours does to the podcast. And that's neither right nor wrong. But I will say, from a sentiment standpoint, Nana is very well aware of sentiment.
Yeah.
My mother, not so much. So if I got a text from my mom about
it would
Bitcoin,
be very impactful.
Yes, very impactful. And my oldest son, is telling me Instagram is all full of like crypto's going to blow up.
Really?
I think blow up meaning to the upside, like it's a positive thing.
Yeah.
What I find fascinating about crypto,
it's supposed to be the summer of Bitcoin.
It could be.
That's what I keep hearing.
I think crypto is its own thing, but I also think crypto is, how would I describe this? The sentiment behind crypto, there's half of it that is gold bug like, that no matter what you say, what you do, what happens with price, there's going to be the hodl narrative, right? Like, you're going to hold on to this. This is the future. This is whatever. That's the same sentiment you had out of gold bugs. So you have to measure sentiment different for gold or precious metals as you do for crypto. That's the way I view it. And here we sit at a horizontal level, 60 to 65,000. What do you think, Ian? What are we talking about here with Bitcoin?
Bitcoin goes. Yeah, I think all of the maxis are going to get their wish of 100,000. I mean, that would be the Fibonacci, not to jump back up on the Fibonacci train.
No, you should. You should.
Yeah,
it's our podcast.
All-time high, which was 68 in November, 68,000, November 2021, all the way down to the recent low, November 2022 at 15,000. Golly, I forgot we got down to 15,000. That extension takes you to a little over, we're going to call it 100,000. It takes you like, I don't know, pick where you want to draw your lines. We use crayons. We're going to call it 100,000, but that would be a practical target.
You can use 65,000 to manage that risk. Our clients are familiar with this. Some of our models are holding Bitcoin using an ETF expression. But your point is like there's room for upside here, and that's perfectly valid. And we have a logical risk management level to use. Why do we have to fight it? And
risk on. I mean, things like crypto going up like this, it doesn't tell me people are skeptical of high beta assets.
Yes. Okay. So I'm going to try to marry a couple concepts here. You did a good job highlighting that the breadth thrust, the increase in participation that we saw in early November into December, we saw small caps lead. When we look at small caps, the things that led, biotech. Also in conjunction with that, we've seen crypto continue to advance. So when you sit there and analyze that type of behavior, we're buying small caps, but not only are we buying small caps, we're buying biotech, but we're not buying big cap biotech, we're buying small cap biotech. And then on top of that, we're going to buy crypto exchanges. And on top of that, we're going to buy crypto itself. None of that screams risk off behavior.
No.
You're right. And that's where I get nervous, because as soon as you come through the line as a defensive end and you're diagnosing that what's happening is, I got a QB sack on my hands, your head is also on a swivel going, is this a screen? Because all the pieces are lining up for aggressive behavior. And to me, the evidence points towards and I don't know if it's just to me, but to you as well, it's really hard this market is leaving people behind. And it goes back to what we started the podcast with this BTFD sentiment that went back to 2020, 2021. I would argue 2017, even before then. Buy the dip is not a sentiment you've seen before. And here we are on the weekly trend pronouncing it as this does appear to be a new environment, a resurgence of an uptrend that is being kicked off by breadth thrust from last year that we might not even be in the middle part of. That buying the dip needs to be what's happening. And are you ready? Is your advisor, is your planner, are you as an asset manager who's listening to this ready to go to work when there is a correction? Because there will be. I'm not here to say
there will be.
Right. There's good.
Yeah, that's what they said in March 2017, though.
Right. Yeah, that's a great point. That's a great point.
That's what they say. And then, you get one, but it's not on your time frame. It's on Mr. Market's time frame. You got one in January 2018. You got a big one.
You have yourself a situation where if you're not involved, you're stuck. And if there's a correction, it's, I told you so. But is it really? Because it's probably an environment where you should be putting money to work.
Yeah.
And so time will tell. And
there will be people. I mean, okay, you look at March 1st, where we are today of 2017, market was already up 7%. We're up how much already this year?
Yeah, I mean,
hold on. S&P's up 7. S&P as of today 7, little over 7. NASDAQ's up a little under 9. And then you say, okay, I'll wait. What our first? And then January 2018 rolls around, Volmageddon, and you get your 12% correction. I told you it was. But the lows of that correction are still 6% higher than the highs from March 1st. So always in context, always in context.
It's always in context. That has to be everything. Like
Life.
life, correct. Everything in context. Sports, life, markets, context. Like bullish percent right now in O's, middle of the field. We're about to flip the X's. What does that mean? That means that's a normal football game and the offense just got the ball. And Ian's point is, can you believe? Like he's not saying, can you believe the offense got the ball? But there's going to be many people that do believe that.
Wait, say that. What's about to happen?
So bullish percent
Yes.
on the New York Stock Exchange.
Yeah, I just looked at this yesterday.
So flip the O's like last month.
Yep.
And that's indicative where it flipped the O's is indicative of the defense taking the field, but a
Yep.
normal progression in a game. Like it's a field possession game. We scored some offense, right? When you look at the price performance of American markets in November, December, really great advance. We scored 2 touchdowns. We got the ball again. Yes, we didn't go score, but we punted the ball. That's what happened in December and January. We're on the verge of getting the ball back. There's still this disbelief on where we are in the game. My point being, we're up by 2 touchdowns. We're about to get the ball back. And there's most likely investor sentiment that's saying this can't be real.
Yeah, and we're getting a good field position too.
Yes.
Like really
great
good
field position. There has been a breath correction underneath the surface. And what I mean, breath
100%.
correction.
That's one have been, and like, I mean, we've talked about it, been very aware of it. Like we've posted all the metrics, talked about all the metrics, whether it's on here or internally. The breath deterioration did happen. There's no
Right.
denying that.
The breadth deterioration wasn't an expansion in new lows. It was just the lack of new highs. And that's okay. Like,
But indices never went down.
right. The indices never went down. And so
I can
here
say,
you
right, we can sit here and say, wow, like you don't sell something. You can be very aware of what's going on under the surface. But until price tells you to sell it,
I think you're at a spot where you're no man's land. Like, are you supposed to get over allocated? How do you manage that? You're at a really tough spot unless you're dealing with small caps. I mean, small caps are a really strong horizontal level. We've had this breadth correction that's taken 2 months, 2.5 months, and you have small caps on the verge of breaking 2010 on IWM or 2100 on futures. There is really quality, I don't know how else to describe it, information setting up for breadth expansion. The offense just got the ball back, and the Chiefs are going to win the Super Bowl again. Like, this is what's happening. Like, trend.
well, and there's no mathematic, going back to fibs, there's no mathematical resistance for another 6%.
Yeah.
Like, so what, like and how do you take that in consideration?
If there's advisors or planners or institutions that aren't involved, they are really in a sticky spot. And if you've been involved or are on the verge of some type of correction in the market, man, do you have to be looking at the opportunity out of that correction. This isn't April 2022.
No,
This
it's a correction with an upward sloping 200 day.
This isn't February and March of 2020. This isn't October, November, December of 2022. The correction that's happened mid-December through now, perfectly normal, perfectly healthy, happening underneath the surface. And do we get a negative March? I have no idea. That's what tends to happen is you have a negative to slightly flat March, seasonally speaking, in an election year, sitting president, those type of things. Whatever seasonal parameters you use, March tends to be flat to down. Don't get that. Man, that is bullish information. And even if we do, that doesn't negate the bullish information. And so that's where my head is on a swivel. We're going, what am I missing? So, Ian, where are we wrong? Where are we wrong on this thesis? Because we always have to identify where are we wrong. It's like a shooter in basketball, right? What does a shooter in basketball do? They follow their shot. Not because they don't think the shot's going in, but you have to be ready when it's not going to go in. Where are we missing?
That's such a good analogy. I think short term, if you were, super short term, talking about S&P here, below 50-50. If you are below the gap from below 5,000, 49.50-ish, we had that gap up on, what was that, last Thursday, That probably takes you. Yeah, I mean, I think that they're
the 22nd, February 22nd. We have a
yeah,
gap
you're
up.
probably going back to 4,800 where you're okay. So where you turn into being more intermediate to long-term wrong is obviously below 4,800.
Big
We
picture.
get to April, May, or some point, whenever it happens. And I'll preface it with this. I don't ever in the history of the stock market want to really be back below 4,800. I don't care what the behavior looks like to help that come to fruition. We go higher into 4,600 or 5,600, and then somehow later this fall end up back below 4,800. Bad news. Bad news. Probably.
Super bad news. Yep. And I think we can look at some really underneath the surface. I think your S&P analysis is spot on, like that gap from the 22nd. If IWM is not holding this auctioning up, the 2021 volume weighted average price near 188 on IWM, or the COVID VWAP lows near 186. If we can't hold that, that's a problem domestically. You look at the EU All World Index, if we're back below 56, I feel like we should have spent more time on the Nikkei exceeding 40,000.
Is this going to be a confirm? I mean, yeah, look at it again today. I mean, this is a pretty solid. We haven't really dillied around here, have we?
No, it's like a hot knife through butter. And same with the DAX. Like the DAX hasn't looked back.
When you pull up a long-term chart, here's what I'm saying. When you pull up these long-term charts, even before when you and I had nothing to do with markets, and you say, wow, wouldn't it have been fun to be involved in that? Don't look back on this and say, oh yeah, that was one of those. Wow, that just absolutely vertical move. Oh man, that would have been fun. Don't sit back in a few years from now and say, oh yeah, I missed out on that because my grocery bill was high. And I thought that was just meant we had a bad economy.
I mean, that goes back to, am I in cash because it's a bubble, or is it a bubble because I'm in cash? Inflation, quote unquote, inflation adjusted, those type of sentiment or comments. I think that's
like even the DAX. I mean, the DAX, 1990s was up 500%.
Yeah.
The NASDAQ's always going to get the most attention if you talk about the 90s and .com. And that was in the middle of an uptrend. That wasn't even coming off a bottom. It's not like we had some big German market bottom in 1989 and that led to, no, that was coming off, they had their 87 crash. They had a 110% rally before that one. Had a correction and then went up another 500% over the next, decade. But I digress.
And this is an environment where, are we seeing Chinese stocks rebound? Yes. Is there some strength internationally? Yes, in spots. Are you seeing demand for biotech and semiconductors? Yes, and small caps. This is not risk-off behavior.
Not run unless this is a new category of safety. It's not a flight to safety trade.
I'm going to leave our listeners with this because we do have to close down. But the gold thing that's happened this week, what we're seeing out of the demand for gold and gold futures, using whether it's GLD or using actual gold futures, this is a really important level. And many times in the past, gold has been viewed as risk off. It might be a dollar story, or it could just be its own story. Like this consolidation that we've seen in gold that goes back to 2020, that actually is in conjunction with the highs that we saw in 2011 and 2012. This is a really quality setup on an absolute basis for gold. We're not going to be able to spend this podcast on. And so there's all these things that are setting up. And I'm not saying gold's going to outpace stocks.
Yeah, and that's going to be the dagger in the heart if it doesn't.
Right. Like it could have and how bullish is it for stocks? Let me paint this picture. On an absolute basis, on its own, gold looks really good. Like if you're just to look at gold by itself, it looks good.
Yeah.
And it's underperforming stocks. How much better a stock could have performed then? And that's where you start to get nervous, paranoid about, wow, there's a lot setting up here for continued bullish behavior. And how much more bullish does it get? Here's the irony. How much more bullish does it get, Ian, if we do get a cooling off in March? That would be extremely positive behavior to see stocks consolidate and correct 5 or 8%.
Think about this is all on the back of breaking above 4,800.
Yep.
To extrapolate on my sentiment from a few minutes ago, you guys that listen to this, you know how we feel about all-time highs. I'm not going to rehash that, especially a monthly candle like we just saw on S&P. Don't sit back in 10 years and say, oh man, that breakout, that monthly breakout to all-time highs. And I'm being serious when I say that. And again, if this fails, we're back below 4,800, all bets off the table. But there's potential here for some very serious wealth creation potential over the next multiple years, if you're willing to follow the trend.
And it's going to have counter trend moves. It's going to have moves that are -5, -10, -15%. It's going to have that. And we're not here to tell the market what to do. We've just come off a really strong start to 2024. It's been a really fantastic 4-month move.
We went sideways. 93 was like late 93 into early 95.
Yep.
15, I mean, in the 90s. And that was part of, how big of a bigger picture move.
Yep. Completely agree. And so at this point, Ian, with us bumping up against the end of our podcast, I do want to highlight the supporter of this podcast, Adaptive Select ETF, listed on the NYSE under ticker ADPV, which helps investors access to the most prevalent factors in markets, momentum and relative strength. Using proprietary identification methods, Adaptive Select ETF attempts to own the strongest 25 large cap stocks when markets are in an uptrend. And since not all market environments are the same, Adaptive Select seeks to prevent extended declines by moving to short-term treasury bills and cash during long-term market downtrends. Investors can find out more, including how to invest in ADPV, by visiting adpvetf.com or calling 1-833-880-5200. Investing involves risk, including possible loss of principal. ADPV is distributed by Quasar Distributors, LLC. Ian, anything you want to touch base on before we close this down?
No, I feel like I have spoken how I feel. Even gave the other side of, like you said, where are we wrong at?
Right.
And that is 4,800. That is a line in the sand. I mean, that is a thick line in the sand that you can use for months and years to come.
Yep, 100%. And right now, Ian, and what we're highlighting on this episode is buying the dip is the most likely scenario going forward. Most will not have courage to do it. We are in a new bull market regime. The characteristics of the market remain solid. That being said, as Ian said, if we're below a 200-day moving average or below 4,800, that changes. We are at an important spot in the market for individuals who are not involved. Bless them as they try to get involved. If you're listening to this, you love the podcast, you want to share with others, please do so. We're on all platforms. If you like it, one of the best compliments you can give us is sharing with others, giving us a high ranking. Ian, another excellent episode. Appreciate you being on here.
Have a great weekend, everyone.